What's going on, everybody? It's Brian Tripp. I'm here in beautiful Birmingham, Alabama. So glad you decided to join us today for another episode of the Alaria Masterclass podcast. This is Alabama's only real estate podcast. A lot of times we get on local guests, but sometimes we get on fantastic, as you guys know, guests that can provide us with perspective from all over the country when it comes to real estate investing. And today is no different. This is episode number 81, and we have the one and only Mr. John Hyre with us today. How's it going, John?
Good. Glad to be here. Coming from Orlando, Florida today instead of Columbus, Ohio.
So, yeah, we won't talk about Ohio. You know, we're in Alabama. There's that little Urban Meyer, Nick Saban thing going on. We'll leave that alone. But usually out of Ohio, but you're doing a workshop right now, and you were so gracious enough to give us some of your time while you got one of those going on.
Yeah, happy to do it during the afternoon. Workshops 7 a.m. to noon. Why would people tolerate that? It's tax-driven, man. What we did is we set it up so that we meet 5 hours a day. That makes the day a quote-unquote business day for the IRS, which means you can write off your hotel, your meals, your travel. What do they do from noon until about midnight? Go to the beach, go to Disney World, whatever.
Yep.
It's a good way to write off a vacation.
Perfect. And that's a perfect lead in. I want to kind of give you a little bit of an introduction. I'm going to have you explain it even more. According to your website, you're an attorney, an accountant, and a real estate investor. That's like the trifecta. It's like the perfect.
Yep. And it lists my order of competence. I'm a really, really good lawyer. I'm a good accountant. I'm an okay real estate investor. I've been doing it for a while. We get better deals now, but I'll tell you what, I'm a horrible manager. Thank God for other people managing rental properties because I'm really bad at it.
But that is an incredible trifecta for a lot, especially our audience or any real estate investor audience that wants the legal advice coupled with that tax advice, because they really and truly, a lot of it goes hand in hand. And I want to actually, if you don't mind, John, I want to kind of dig into the fundamentals of bookkeeping when it comes to, especially for the smaller guy, the guy that's maybe not doing the volume, maybe under $500,000 gross revenue per year, the guy that's not doing huge volume, but the fundamentals of bookkeeping, how to keep good books and just stuff like that. I know that we're kind of out of tax season now, but my corporate taxes are coming due here pretty soon. So it's probably going to affect me and maybe some other people listening to this. Tax reform. I want to talk about that, some stuff that happened earlier this year. And then some IRAs. I want to dig into IRAs. Your website calls you the IRA lawyer. So
yeah, it's IRAlawyer.com and realestatetaxlaw.com. They kind of both tell you what I do.
Perfect. So we're going to dig into all that. But before we get into any of that, John, I'd love to know your story. I want to know how you even got into this to begin with.
Well, let's see. Lawyering, I got into because I argue with everybody and everything. I mean, when there aren't people around to argue with, I'll argue with a table or a chair. And it's been that way since I was probably 6 or 7. And then I have an accounting and finance background from undergrad. And several people I respect told me do tax law. Plus, as I got into it, I love it. Why do I love it? Well, I got a philosophy. I believe if you earned it, you should keep most of it. Unlike a certain other president whose name we won't mention, I think you did build that. And so I really have a passion for helping people keep what they earn. So that's part of it. It's complicated, so I like the challenge, the intellectual challenge, and I like to win. Got the alpha thing going. And finally, it pays pretty good. It beats the hell out of working for a living. So that's how I got there. And then the real estate investment, of all things, I started with trailers, Lonnie deals. I would go buy trailers for cash and then sell them on notes.
Yep. And
I learned real estate. I made a lot of dumb moves, made some pretty dumb mistakes, but I learned fairly cheap. So we still do a lot of low-income rentals. That's pretty much my shtick. And with me being Latin, my mom's from El Salvador, my wife's from Chile, I speak Spanish at home. I like dealing a lot with first-generation Latins because they come here to work. Now, second generation's a different story, but first generation, they come here to work.
Wow. I have a trailer park. I have a 59 space trailer park, and I know all about Lonnie Dales. I know we've actually had a lot of trailer park discussion on this podcast, but you're right though. I have a park full of Hispanics, and this is the best paying customers I've ever had. They work their tails off. We have 2 white families in our park, and they're the ones that are sitting on their porch collecting the check.
Yep. Yeah, well, the Latins, if the first generation, if you take care of them, they will generally take care of you. Yeah. And every culture's got its quirks. You got to be on top of them not having 50 people living in one trailer. You can usually tell by the 25 vehicles on the lawn. So you got to watch out for that.
All right, let's dig into some stuff. Let's really get into some stuff here. I was told, I just got off the phone with our mutual friend Jeff Watson, and he said before we get going, I need to warn everybody. I was told I need to get hyped up on some caffeine before we get going, and I was told to recommend that to the audience that's listening. Buckle your seatbelts. Let's go. I really want to dig into some of this stuff. I think it's going to be really good. I know it is. Fundamentals of bookkeeping for kind of your average, your mom and pop, maybe real estate investor. What are some things, John, that we should do as real estate investors that are just kind of non-negotiable? We should be doing this, even though you probably know we're not doing it.
You don't pay cash for anything. When you're in a business, you pay with credit card, debit card, check, electronic funds transfer, something that's verifiable. You do not pay cash for anything, not even your contractors, especially not your contractors.
Is that so you can track things?
Yeah, so you can prove to the IRS that you actually paid it and to whom you paid it. And then, what a lot of clients will say is, well, I got a receipt that says I paid Jose the contractor cash. Then the IRS will look at the receipt and say, looks like you wrote that up last night. Why don't you prove to me that you actually paid him? Why don't you bring him in and let me ask him? And then, of course, you tell him, well, the IRS wants to talk to you, and he's gone. If you're paying contractors in cash, it's because they're intending to evade taxes. And you need to understand that you're potentially liable for that. We've seen people where the IRS comes after them for the money that they paid contractors in cash and didn't report on a W-2 or reported on a wrong 1099. So you don't pay cash. You pay everything so you can prove it and the bank tracks it.
Right.
Number two, I would use QuickBooks or similar software. I don't like Quicken. It's not real good with a balance sheet, and real estate's a balance sheet heavy business. So we like QuickBooks Pro, the desktop version. It's only like $200 over at Sam's Club or Costco, but you got to learn how to use it. You need a good chart of accounts. You need some instruction on how to use that program. It's intuitive if you're taught right. It's not hard to do. You download all the information from the bank, and all you got to fill in, if you download everything from the bank, is the account that you're using. What does that mean? For example, if someone gives me money, well, is that rental income? That's one account. Is it a deposit on a rental? That's another account. Is it interest income? That's another account. So you just got to be good at multiple choice and pick which account. And then you got to tell the software which property. Which property are we dealing with here? Because the bank's not going to know that. So the bank will fill out everything else, the date, the money, who you paid, everything.
Yep.
You got to tell them what it's for by choosing the right account and which property. That's it. It's not hard.
Yeah. So, okay, that's some awesome stuff. So you led me to another question, though, because you brought up 1099 versus W-2, and that's a huge discussion amongst people that I'm friends with, amongst real estate investors here locally. I'm sure it is nationally as well. What constitutes a 1099 person versus a W-2 waged employee? What can I get away with? Is that even the right words? What can I get away with as far as 1099 goes?
Like a lot of things with the IRS, it's not a simple question. They have a 20-point test that you don't want me to discuss now, or that's all we'll talk about. The basics of it are this. Do you have control over them, and are they dependent on you economically? The more control you got, I'll give you an example. Your secretary is a W-2. No, John, no. I pay her a 1099 and it's a piece of paper and it says she's a 1099 and she signed the paper. That's what they tell me. Doesn't matter. With the IRS, they ignore the paperwork and look at what you actually did. And so if the secretary, you have so much control typically over an admin person because you're telling them exactly what to do.
Right.
Second, if they're dependent on you, they're probably a W-2. In other words, if they don't work for anyone else, you probably got a W-2 person there. So for example, the other extreme is the contractors who work on your properties, if they charge by the job instead of by the hour in particular, that's a contractor, especially if they work for other people. So that's kind of the opposite end of the scale. So how much control do you have, and are they economically dependent on you is sort of a shotgun test, a rough test.
Right. And I'm sure, like you said, with everything, it's kind of, with the IRS, there's so many different variables going on. Those probably aren't, there probably could be a circumstance where it is their only income, at least for a short period of time, maybe. I'm sure there are different things that.
It's a factor, that's the problem. It's all factors and they kind of weigh them all together. But I'd say those are the two big ones.
Yeah. So you've obviously done a lot of litigation too. Like you've actually tested stuff. That's correct?
Yeah, we sue the IRS and tax court. It's good fun.
So what are some of the more common, talk about that for a second. What are some of the more common things that you are suing the IRS for?
We sue on self-directed IRAs. Okay. We sue on real estate professional status, which means if you have enough rental properties showing a loss, if you qualify as a real estate professional, which is not a dealer, those are two totally different things. If you're a real estate professional, you can write off losses from your rentals against your other income, like your W-2 income or your flipping income. So we do some of that. I'll say by far the most common is somebody gets audited and their records are sloppy. Right, they don't keep receipts. They don't have QuickBooks. They write off whatever they want without paying any attention to the rules. Those are pretty common. We can't always help those people. It just depends how far gone it is. What else? Health insurance deductions are pretty common one we see. Car mileage tracking is a common one for sure. Deducting interest, especially on something creative like a subject to deal, we've litigated that. So pretty much if you get audited and the result goes badly, we'll look at the audit, assuming we didn't represent you. If we represent you, obviously we know what's going on and you probably got a better result. But we'll look at the result and see, can we get it turned around or did you screw up and it's not worth suing?
Right. What specifically, John, when you start talking about health insurance and car mileage, like what specifically are you referring to that you would sue them for?
Okay. Can you see me okay?
A little bit. You got the sun coming in, but it's good.
Is that better or worse right there?
Worse.
Okay.
It's good. It's good. Hey, the content's the content.
I was getting just comfortable here.
Just get comfortable. It's good.
On the sofa. Okay, cars. You got to track your mileage.
Right.
I mean, if you don't track the mileage on the car and they audit you, you're dead.
But I guess the question I have is, what are you suing them for? Like what?
Okay, sometimes I only sue if I think we're going to win, right? So let's say you got car mileage, you didn't track it. That's just black letter law. I'm not going to win that lawsuit. Now, let's say you tracked it, but it wasn't perfect tracking. Maybe like what we tell clients to do, we tell them to track 1 week of the month, usually the second week of the month every month, and then prorate the number they got to the rest of the month. So let's say in the second week of June, you drove 77.62% business miles. We're going to use that number for the other 3 weeks of the month. You might get an IRS agent who won't take that. That's gray. I'd say they have to take it, and we'll fight them on it. We've done some with IRAs where somebody invested. Oh, go ahead.
Yeah, let's talk about that. I think car mileage, I want to talk about stuff, John, that it really and truly applies to that mom and pop guy, that investor that's definitely doing way less, $500,000 and under. And I think car mileage is a huge one because we all get that deduction and are all talking about that. So what do you mean by track? Like, what should we be doing specifically to track our car mileage?
1 week of the month, you should track everywhere you drive. Now, if it's personal, you just put personal. If it's business, you describe what you did. I drove to this rental. It was 3.4 miles, and then I went from this rental to that rental, and that was 2.2 miles, and you put the address. And then I drove to Home Depot and bought a bunch of stuff. That kind of tracking. And it's a pain in the butt. Don't get me wrong. I don't want to do it, but I know I have to do it. You track in good detail for a week. And that's why I tell people just do it for a week. Nobody wants to do that for a whole month. There are apps that'll do that as well.
Right.
You Google, there's plenty of apps that'll do it. I still do it old-fashioned by hand.
So, John, you said that it's a pain in the butt. So for the person out there that's not doing this, because in your estimation, there's probably a far majority that are not doing it the right way. So for those of us who are not doing this by the book like you just laid it out, are we just dead in the water if we get audited?
If the auditor wants you to be. Depends how sympathetic they are and what they think of you. If they want to push it and disallow all of it, you're going to lose, right? Because the law says real clearly you got to be able to track it and back it up. And if you don't back it up, now some auditors, especially if you recreate a mileage log, they'll give you something, maybe 30%, maybe 50%, maybe 60% if you get lucky. And some people decide, you know what, we're going to take the mileage. It's not worth our time to track it. We're not going to do it. If we get audited, we'll pay them the money. Mm-hmm. Now, that isn't most people's attitude. When they get audited, they sing the blues. but they don't realize they have to do that. Or they know it, they just don't do it because, again, it's a pain. I understand. Nobody wants to do it.
Mm-hmm.
I would use one of the apps. It's like anything else. If you get into the habit of doing it, you'll do it.
Right. Totally. I thank you, because I think that's a really practical thing for a lot of our audience. And then you mentioned health insurance too. What specifically are you going after the IRS for? What kind of mistakes do you see from real estate investors? First of all, what can we do? And then what kind of mistakes are you seeing that we're not doing correctly?
So if you're an entrepreneur with health insurance, it's got to be paid by your company. If you pay it personally, the company has to reimburse you.
Mm-hmm.
Where we see the taxpayer make a mistake is they pay it personally, and then they just can't write it off. We just went through an audit like that where the guy, his accountant just never told him, hey, that's one of the rules. If you pay it personally, it doesn't work. The company has to pay. Where do we see the IRS making mistakes? Oftentimes we deal with health savings accounts, especially self-directed ones. So just like a Roth IRA, you might go buy a bunch of rentals in a health savings account, or you might do a flip in a health savings account. And then you use the income to pay for health expenses. And sometimes the IRS questions, because they're not real well educated on this, they might come back and say, you're not allowed to do rental properties in an HSA. You can't do that. We're disallowing this. Well, actually, the law is really clear. So we're going to win that one. Or they might come back and say, your swimming pool's not a healthcare expense. Why'd you write that off through your HSA? Well, I got a prescription from a doctor that says because of my bad back or my bad heart, I need to swim. So I built a pool. There's case law. There's actually case law that says you can do it if a doctor prescribes it. Now, you probably can't go get meth equipment. You leave that to your trailer people.
Right. I want to talk about, I want to get more into HSAs. That's interesting. But what, so the company has to pay for it. So if I'm
for the insurance, yeah.
So we're talking about the insurance, health insurance. Say I'm a solopreneur, and how can I do this if I'm just all by myself? How can I get it to where my company pays for my health insurance?
All right. The first question is, do you have an entity? And you don't have to have one. Like when you get started and you're brand new, you might not have one, or you might only have one little LLC, which is fine. I'm a real fan of starting simple. So on asset protection, these outfits that sell newbies, these $10,000 packages, and
right.
You need 5 LLCs, and 3 need to be in Nevada, and 1 needs to be in Delaware, and you got to have a C corporation and 30 trusts. That's a crock of feces right there.
Yeah, I went through that, by the way.
Yeah, that's the people that do it start with an A.
They did.
Yeah, and they're notorious for it.
They're from Las Vegas.
They're not from Vegas. They're actually Washington State.
They have an office in Vegas, I should say. They do have an office in Washington State, yes.
Yeah, they sell it all like the big gurus. They'll be in the back of the room selling the package. Don't buy an asset protection package from anyone from Nevada or Utah. It's a ripoff. It's a total ripoff. Because what they want to do is generate money.
Yep.
So first, they scare the hell out of you. And then second, they say, well, you're going to be huge. So why don't we set up a structure for a guy who's going to be huge?
Yep.
Then let's charge you a huge bill. And here's my answer. Because I ain't huge yet. Wait till I get huge, and then we'll talk about that stuff. I can't stand those people. It's wrong. I could do it. I could sell that to people. I don't, because it's wrong. I can't look in a mirror if I do that. So start simple. If you're just getting started in the business, start with 1 LLC. Because, for asset protection, if you're a newbie, you usually lack the one thing we need, and that's called assets.
That's right.
Right? If you're going to have asset protection, you need assets. Now, let's say you're a newbie in real estate, but not at something else. Let's say you're a doctor and you got a practice for 10 years and you got real money and you've got a bunch of stocks and stuff. That's a little different. You're not really a newbie. You might be a newbie in real estate, but you're not a newbie at making money.
Right.
So we're going to be a little more protective because that guy's got something to lose.
Right.
With smaller guys, because remember, I have a real estate business. So I really I want to do what's right. And I have to take into account not just the taxes and the asset protection, but your business situation. I'm not going to set up a $10,000 structure for a $1,000 guy. Totally. What I'm going to do is say, here's your $1,000 structure, a lot simpler. It's going to get you what you need. Once you're big, come talk to me.
Right.
Once you've got way more flips or rentals and expanded, now let's talk about you need more protection, but you can also afford it. What a nice fit. And let me add, if we're doing a huge structure for you up front, we're speculating as to what you're going to do in the future.
Right. You have no idea what I'm even going to be doing, flips or wholesale or whatever. Yeah, I get it.
So we do asset protection for large, sophisticated clients, but we also do it for newbies. And the price changes a lot when you're doing it for a newbie.
Sure.
Now, I will tell you, so I try to help the noobs by not screwing them, by giving them good advice at a decent price. But that's a two-way street. I'll tell you what annoys me about the noobs. John, can I take you to lunch and pick your brain? Sure, instead of $400 an hour, I can get fat and you can buy me something for $20, and that sounds like a great deal for me. Let's do that. Hell, let's do dinner too while we're at it. No, I don't want to go to lunch with you and let you pick my brain. I want to make a living. Help me make a living. And I want you to make a living, so I'm not going to screw you silly like this group out of Nevada and overcharge you for a bunch of garbage you don't need. Mutual respect, mutual capitalism, mutual profit.
See, the answer you gave to that question, I can't give. That's the answer I want to give, but I can't give that. I get asked to lunch. I'm sure you do too, like all day, every day. And that's the answer I want to give, but I don't give.
Yeah, here's the answer. When I go to lunch, it's rare. Sometimes I'll go. The first thing I say is the only reason I'll do it. I'm blessed, and I'm real thankful for that. I have met more quality people, really good people, that I would love. I don't have the time to get to know every good human being, every quality person I meet. Yeah. And I'm so blessed to be able to meet so many of them. So I don't say no to be a jerk. It's just, man, I got to sleep sometime. I can't eat all day. So if I say yes, there's two rules. A, I really like you. There's something about you I like. Now, if I were single, it's because you look like Selma Hayek. But now that I'm married and the wife gets evil about that stuff, we don't do that. And the other thing is I set the rules. I'll go to lunch, but we're not talking taxes and legal. Don't ask me taxes and legal. You want to talk politics and make fun of communists? We can do that. That's fun. Various different things, but.
All right, so we're gonna steer on to go to our next topic. But that's good with you.
Danger.
No politics. We try to do no politics on the show. Try to do our best. John, let me ask you about tax reform, because I know it's been 6-7 months now since the new stuff, all the new stuff came out. Maybe for people who are going to be working on 2018's taxes for next year, what are some just simple things that we need to know about the tax reform that maybe we can, kind of carry over to, the next tax season?
Let me ask you this. Do your listeners, is their profile buy and hold, wholesale, rehab, all of the above? What do your listeners do?
Probably all of the above. We've got a lot of, probably a quarter of our audience is from out of state, who primarily are probably listening because they own property here. So that's probably a quarter of our audience. The rest of them are, I would say half the audience is brand new.
Yeah, okay. And a lot of them want to wholesale because they can't really do much else.
Correct. And then we get a few guys that are flipping that are.
So here are three big things with tax reform, and there's a bunch. I did an 8-hour webinar on the topic, so obviously there's a lot, and that was directed at real estate investors. But the top three things I would do: one, you got to get to know what's called the pass-through deduction, and the Congress misspelled it on purpose. They thought they were being cute, so it's PASS-THRU, pass-through deduction. This is a deduction of up to 20% of your net income. So if your business makes net income of, say, $100,000, this is possibly a 20% tax deduction for you. That's a huge amount of money. You need to get to know that, because for real estate investors, it really is applicable. The first question is, to qualify, you got to have a trade or business, which is distinct from a mere investment. So you got to have enough activity that's a trade or business. I don't think that's a problem for assignment people and wholesalers. I think for rehab people, it could be an issue because some of them don't treat it as a trade or business. They treat it as cap gains on Schedule D as in dog.
Right.
And for landlords and lenders, you got to have enough activity that it's a trade or business. It's kind of a gray issue.
Will you define that? What's a trade or business specifically?
See, that's a problem. It's hard to define because it changes depending on what you do. So there's case law that says you got to do this much if you're a landlord to be a trade or business. You got to do these things if you're a lender for your lending thing to be a trade or business. So that's the problem with it. There's some gray. You got to have an accountant or a tax lawyer. And by the way, I take clients all over the country. Hint,
we're going to get to that.
That knows how these different businesses are treated. Let me give you one example. To have a trader business, which is a good thing to have, as a landlord, you need to have at least 2 rental units and be hands-on. Even if there's a management company, someone's doing the work. Yeah. Now, if you have one property or it's triple net lease, if you got triple net lease properties, that could be a problem. So having a trader business, if you're a landlord, is real easy. Most of you do it without thinking about it. Like your trailer park is clearly a trader business. There's just no question.
Totally.
You get into lending, like you got your clients out there, your listeners who are lenders, that gets a little more complicated. I won't go into it now, but just understand there are some moving parts. You got to talk to your CPA, assuming they know. A lot of them don't because they don't get enough in the real estate. Mm-hmm. If you're rehabbing and reporting the income on Schedule C as in cat, you're a trader business. If you're reporting the income on Schedule D as in dog, you're not a trader business.
Gotcha.
So just a couple pointers on that, but it's important to research that because it's 20% of your net income. It's a huge discount on taxes. That's the number one thing I would research, the pass-through deduction for real estate investors on the new tax law, if I were your listeners.
And before we do those next couple, I think you said there were 2 or 3 we need to know. John, I think this is the biggest question that most people might be trying to get out of this. You obviously you do a lot of educating, you put on some seminars, you do a lot of educating yourself. I feel like this is something that I need to be educated, but I feel like I don't want to know everything. I would rather give this to a professional and let them do it. Right? Is that right? Or
yes and no.
Why do I want to know all of this detail and possibly really screw myself up and get into big trouble?
It depends on the cost, right? If you're a brand noob getting started and you don't want to be paying someone, because I'm not cheap. If you consult with me, it's $400 an hour. Worth every nickel, right? My goal is to save you 10 to 40 times what you pay me, and I usually accomplish it. But for some people, it's just not going to happen. But you know what? So if they can't pay a certain amount, what that tells me, they're short on money, but probably long on time. Plus, even if you take the seminars, I don't know that the object is to become as good at it as your CPA. That's not efficient. But you want to know enough to know if the CPA is doing it right.
But even then, I know enough that I know that my CPA is maybe he's doing it right, but missing a couple of things. What am I going to do then? I need that just lets me know I need to fire him and move on to someone else.
Yeah, you got to find someone who knows if that's the case. First, you have to realize that's what's happening, which a lot of the time you don't know enough, so you don't know that they don't know.
But so wouldn't I just rather just forget all that nonsense and just hand it to someone who's a clear professional like yourself, who is an attorney? But if you're going to save me 10 to 40 times, and I don't even understand what's the discussion.
That's okay. So you've been doing it long enough. A lot of the noobs in particular. So first of all, let's talk noobs and then let's talk landlords.
Okay.
Noobs a lot of the time don't see the value. They're like, that sounds like a lot of money. I'm not going to pay it. And they don't ever realize how much extra they paid in taxes that they could have avoided.
Right.
Because one of the things we do is we screen pretty quick. Like a brand noob, a new noob, I try to spend like just 2 hours with them per year, maybe 3 hours, unless they're a hardcore noob. Because some noobs hit it running and they'll go buy 50 properties their first year. Okay, we're going to spend more than 3 hours with that guy, but he can afford it. But a normal noob, we try to minimize the time. Why? I don't want to run the clock up, but I want to help them. And their situation's simple, so I can usually help quick.
Right.
I'll tell you the worst, landlords. They're just cheap. And I know it's a generalization, so not every landlord's cheap, but a lot of them, good Lord, they'll call my office and say, well, where's my free 1 hour consult? And I'll say, I don't know, where's my date with Salma Hayek? You get that, and I'll give you the hour. I mean,
we'll cut that out so your wife doesn't hear that.
Yeah, really, because she knows I haven't had the date, and I'd like to arrange it. So she told me, she's from Latin America, she's Chilean. So she says, you are allowed to look, but if you touch, I will kill you. That's my life.
Hey, there you go, right? Is that in the prenup?
Clear boundaries, man. Clear boundaries.
No, I think that's great advice. And I'm glad that we went down that road because I feel like that's a lot of people's situations where if you are newer, you maybe just get a little bit of education where you can kind of realize, hey, this guy, I know that this guy's not doing it the way I need to go. I need to find a different guy.
Exactly.
So,
and that's a lot of what we do is review stuff.
Yeah.
And start with an evaluation of where are you at and how's it being done. For
sure. And then just real quickly on landlords, I feel like the really cheap landlords, John, are the ones who are managing it themselves. Mm-hmm. They're already in the business. They're managing everything themselves. That's kind of like the older real estate investors, at least in our city, that have 150, 250 low-end properties, and they've been doing all their property management for decades, and they're super, super cheap. I agree with you there.
And it's fine. It's a decision, a life decision. For me, my time's worth something. The experience is worth something. The time with my kids or my wife or my Salma Hayek fantasies are all worth something. Granted, the last part's probably not worth much. But
to you it is.
Your time's worth something. So
for sure.
I'm fine with people who are cheap. Don't call me. What drives me nuts is when they call and they always try to negotiate. I have to explain to a lot of these investors, look, I'm not motivated. I didn't get a divorce. I'm not in foreclosure. I didn't lose my job. So I'm not negotiating with you.
Hey, when you're the best at what you do, what is there to negotiate, right?
Exactly.
So I want to respect your time, John. And I know we kind of missed a couple of things on the tax reform, but we are going to link up the webinar because isn't there a webinar replay? I think there's a webinar replay. I think I saw it. Is there something where?
Well, the webinar is something that it's with 8 hours. I bill for that puppy.
Okay. Well, we'll link it.
Talk about it. Well, we can link it. Let me do this too. Let me give you 2 little tidbits just so people know what to look for. We won't go deep unless you want to. 1, depreciation on rentals. If you do cost segregation intelligently, the new tax law now allows you to write off, take a tax deduction for, roughly, and that's rough, I'm just guesstimating to give you an idea, 15% of the cost of rental properties that you buy if you buy after September 27th, 2017. So I buy a rental property in 18 for $100,000, and it doesn't have to be brand new. It just has to be new to me. I should be figuring on writing off $15,000 on that purchase. That's new. That's huge. That means landlords won't be paying if they're still acquiring rentals. Yeah. They're not paying tax.
Yeah, that's awesome. And then
the third one, C corporations, right? With the rate on C corporations going down to 21%, it's kind of like a diluted IRA. Like in an IRA, you pay 0%. So people say, well, why didn't I just do IRAs and pay 0 instead of 21%? Well, that might be a good idea. But with a C Corp, yeah, you pay 21%, which if you're in my bracket, that's really looking good. I'm liking 21% a lot. But it's a lot more flexible than an IRA. I can take the money out now if I need it. I can hire family. I can do deals with friends and family.
Right.
So a C corporation nowadays, I would look at it kind of like a diluted IRA. It gets you a better rate if you're in a high bracket, but you still have a lot of flexibility.
Well, you have all that, but you also have the double taxation part, right? So
yeah, that's why I say treat it like an IRA. Don't pull the money out.
Okay, gotcha.
My assumption is, so I'll give you a quick example. I'm moving to Puerto Rico, which Jeff told you not to talk about. But with me moving there, it's because I'm going to pay a tax rate of about 6%, federal, state, and local combined. If I weren't doing that with my law practice in the U.S., what would I do? I would break off part of the law practice, probably the part that does IRA work, put it in a C corporation, because I don't need that money. I don't live on that portion. I live on about 20% of my law practice. So I'd put half in a C corp. I would go ahead and never pull the money out. So instead of 37% tax, I'm paying 21%, and I would reinvest the money inside the C corp. Probably the C corp would have a law practice, and it would also do a lot of hard money lending. Mm-hmm. And that works as long as I don't pull the money out. Now, can I, if I need it? Sure, I just got to pay the toll. You want to cross the bridge? Pay the toll. But the plan is the money stays in the C corp.
Until when?
Yeah, if you're in a high bracket and you weren't going to spend the money anyway, you just want to grow it, that's a win.
But you're going to pay it eventually.
Not necessarily. If you die with the C corp, your kids are going to be real happy. The way the math works out.
Okay. So
So
it's almost like it sounds to me like you're comparing that a lot to a 1031 exchange where
yeah,
defer, and then you die.
yeah, that's the best. Defer, and then die, and you stick the IRS with the bill. The
Right.
last thing you're thinking when you go is, you're waving at the IRS minus four fingers.
Right. I'm with you. Again, I want to respect your time, so I want to hit this last topic if you don't mind. You are the IRA lawyer. Briefly before we go, I want to talk to you. I want to ask you something very specific, and it's regarding wholesaling within a self-directed IRA.
Define wholesaling. Is that a
Okay.
signing?
Okay. Great question. Let's call it assigning contracts.
Yeah, I wouldn't do it.
You wouldn't
Not
assign
with IRA.
contracts, period?
No. Outside of an IRA, I don't have any problem with it.
Okay, so I just read what you wrote about that, and I want you to dig in. I'll link up even that article in our show notes as well. I read this article you wrote about specifically almost like treating your IRA as like, I forgot what you called it, a magical.
Oh yeah, yeah. So here's the deal.
Yeah.
And I hate to start on what you can't do because it's so negative. But you asked, and I'll do it.
No, but because we have a lot of people who
can do.
We have a lot of people who are wholesaling. I think it's important to talk about this issue.
So here's the thing. IRAs invest. What a lot of people do is instead of investing money, they run their services, their personal time through the IRA and say, magically, I don't pay taxes on my personal time. Guys, when you're assigning options or you're assigning a contract you got on a property, as far as the IRS is concerned, here's an important thing to understand about them. The IRS does not respect what's on paper. They respect what you actually do. So on a paper, I understand that you're saying, John, I bought this contract for $100. I sold it for $20,000. I bought an asset and I sold an asset. What don't you get about that? And I've had people get in my face like, are you stupid? Do you not get it, John Hyre? Are you an idiot? Like, no, I know the law. Because when you get a contract, you get a property under contract for $100, that's not an investment. That's trivial. You know what you're really investing? Your time, your knowledge. That's why you would never sell me a contract for $100 because then you'd be giving away your time and knowledge to me for nothing.
Right.
And the IRS knows that. So that's my issue. Wholesaling is a great idea outside of an IRA, but in an IRA, the IRS is going to rip it apart. They're going to rip it apart.
And not only and there's case law now, like an actual
not directly on assignments, but indirectly. You're referring to the Mazzei case, Mazzei. It was a case where somebody bought their IRA bought a C corporation for $500, and then it made a ton of money. And the taxpayer said, kind of with an assignment, he said, "Hey, the stock went up in value. It just went up. I don't know how that happened. It just went up." And the IRS looked at it and said, "Listen up, buddy. We know what you're doing. You got no skin in the game." They had two tests. They said for an IRA investment to be real, you got to have skin in the game. And $500 is not skin in the game when you're pulling out 20 and 30 grand. And second, the IRS said, would you do the same thing with a third party? Meaning, would you, in the case of an assignment, you bought it for 100, would you sell it for 100? No, I'm giving away my time. So you wouldn't do that deal. The only reason that your IRA was able to buy the thing for 100 is because you and your IRA are little friends, right? You're buddy with your IRA. You love your IRA. But you would never do that with me or with a third party. And that's a sign that it's not a legitimate deal for an IRA. So the IRS said they got a two-part test. You got to have skin in the game, and it's got to be a deal you would do with anybody.
So we're clear. If I were to actually because the difference between wholesaling and assignments, or the difference between, I guess wholesaling, buying something and then reselling it for a profit, you can do that within an IRA as long as you are buying the asset first and then selling the asset.
You take title, and I don't mean a simultaneous close where you take title for 20 seconds.
Right.
I mean a legitimate, you take title, and then at some point you resell it. Maybe you rehab it, maybe you don't, maybe you rent it, maybe you don't. That's totally legit.
But so just real quickly to follow up, you said a double close or simultaneous close is not good enough. Why?
substance over form. The IRS would look at the double close and say, that's about the same as an assignment. There was none of your money involved. You owned it for 20 seconds. It was really your effort. It was really you brokering, bringing a buyer and a seller together versus the IRA having skin in the game. Now, if you borrow, it's legit. The IRA can borrow. There are rules.
Right. Borrow to buy the house.
But you pay a tax called UBIT. Right? So the IRA is taxable when it borrows. Right. Although here's a key. This is important. When a 401k borrows on real estate, it avoids that tax. So can a 401k buy something, take title, and then resell it fairly quickly and do it tax-free? Yeah. That's one reason I like 401ks, like solo 401ks, more than I like IRAs. They're more flexible. They got better rules.
So I don't have enough time to go down that rabbit trail, but I want to really pinpoint in on this. I cannot. Let me ask the question this way. If I were to get audited because I double closed on something where I've got $500 in my brand new self-directed Roth IRA, I've got $500 in there, and I put a house under contract through my IRA, and I sold that contract, or I double closed and I made a $20,000 fee, you would not be my attorney to defend me if I got audited.
I'm still the best one to defend you, but we're probably going to lose. Right? And then you say, well, why don't we get a lawyer who believes I'm going to win? If they believe you're going to win, they don't know the law. So do you want a guy who knows the law and doesn't like your odds? Or do you want a guy who thinks it's great because he doesn't know the law? So I'm still the guy to defend you. The problem is our odds are low of winning. Here's what would probably happen, and I've been very good at this. Mm-hmm. We'd probably convince the auditor, or more likely the IRS lawyer, to settle.
And what would happen in that case?
There's risk for them, so we meet somewhere in the middle.
Okay.
We meet somewhere in the middle. In other words, they can argue, if they're really sharp and on the ball, that this was a prohibited transaction and it blows up your IRA. And I would settle either, if we had a good settlement, I'd settle for this being what's called an over-contribution, and you pay a 6% penalty on the amount that was borrowed. Or if the guy's sharper and knows how to push, he's going to argue it's UBIT taxable, that tax I was talking about called UBIT, U-B-I-T.
Right.
And then you're probably looking at closer to 37 to 40% tax on the profit. So it wouldn't blow up the IRA, but you would get taxed. But now your IRA's got way more money and it can still do something.
Right.
So odds are we'd settle that thing out.
John, thank you so much. I feel like we got tremendous value. We obviously can't talk about everything, but I wanted to just kind of pinpoint in on a few things that I feel like is really going to help our audience and help, real estate investors who listen to this. If someone wants to take you up on a potential vacation somewhere, use it as half work and half, when's your next seminar? When's the next time you're doing some training?
All right. The next training, we're actually setting the dates. There's going to be one late September in Atlanta, and that's going to be self-directed IRAs, 2 days. That's
a hop, skip, and a jump from us. Yeah. It's about a 2-hour drive from us. So,
and here's one that will not appeal to Alabama people, but I'll throw it out there. That first weekend of December, we're doing one up in Columbus, Ohio.
Bad weekend.
In Columbus.
You already know that's it's not only that, it's a bad weekend. That's SEC championship weekend as well.
Yeah, see, I'm a sports illiterate, so I wouldn't know that. I pay no attention. The only sports I pay attention to is MMA. I like the mixed martial arts. I like watching the technique.
All right.
And then I think the next vacation type thing we're going to do is probably early next year. February in Puerto Rico would be my guess.
Okay. Which we're not going to talk about anymore because we're not allowed to talk about Puerto Rico or politics.
Wow. What is it with fees?
I don't know. But John, thank you so much. And then how can people get a hold of you if they want to potentially use your services, your accountant services, bookkeeping services, stuff like that?
IRAlawyer.com, or realestatetexlaw.com.
Perfect. We'll link it all up, and I'm going to link up that the article that you write. I know you do a lot. You write a lot of stuff, but that one in particular article that I feel like applies to the wholesaling stuff was really interesting. And we're talking about that with a lot of different people right now. How to defer or pay no taxes on some wholesale revenue coming in. But John, thank you so much for your time. I really do appreciate you.
Hey, good talking to you. Take care.
Awesome. See ya.